We're looking at an analysis of NIO's Q3 2025 earnings, which confirms a really significant pivot for the company. We're talking 16.7% revenue growth, high gross margins, and a historic shift to positive cash flow.
So we're diving straight in. The data is compelling, but we want to focus on the structural choices that can really maximize its impact.
Exactly. This material is robust, no question. It clearly confirms that the story of scale and profitability is taking hold.
But, when you have two dramatically different growth figures like this, the choice of which one you lead with, it basically determines the reader's entire takeaway.
Right. And a key theme here seems to be this massive scaling of demand. The report makes a great case for financial improvement, but let's look closer at how that core growth story is being told.
And this is where we see a real opportunity. The presentation of volume growth compared to the revenue growth rate, well, it slightly understates the true scale of NIO's physical expansion and, its accelerating market traction.
I get why the report anchored on revenue. I mean, the title, the executive summary, they lead with that 16.7% year-over-year increase in revenue. That's $3.06 billion.
Of course.
And for a lot of traditional analysts, that top-line dollar figure is the go-to proxy for health.
And that 16.7% is the weakness. It's because it's actually hiding the real story, the momentum, the underlying metric, vehicle deliveries. It surged by a much, much more dramatic 40.8% year-over-year.
87,000 units.
Exactly. 87,071 units. That 40.8% is a record high. It signals this explosive acceleration, but it feels secondary in the report. The scale of market capture is being overshadowed by a dollar figure that was frankly depressed by their own strategic choices.
Okay, but let me push back a little. What's the risk in prioritizing volume? Isn't leading with revenue, the $3.06 billion, more conventional? Especially for institutional types who just want the top line. Do we risk looking desperate for volume if we bury the money?
I think that risk is manageable. For a high-growth EV company that's still optimizing everything, the suggestion is to reorient the core introductory data, prioritize that volume scaling.
So make sure the report's initial structure reflects the 40.8% figure as the leading indicator.
You have to hit the reader with the most aggressive growth signal first. For a company at this stage, volume is leverage. Period.
Okay, volume is leverage. I like that framing. So if you prioritize volume, what does that really communicate to the reader about the company's future?
It communicates dominance, infrastructure dominance, supply chain power. Every single unit they ship reinforces the bull case in a way that a revenue percentage just can't.
Right.
Think about the implications of 40.8% physical growth. It translates directly into better utilization of battery contracts, more leverage with suppliers. It's the foundation for future profitability, not just a lagging indicator.
Okay, that's clear. So how would we execute that? What's a concrete way to make that 40.8% figure really pop?
Well, for one, you could restructure the executive summary, lead with the 40.8% delivery growth, and you explicitly label it something like record high demand. That sets the tone immediately, explosive scale.
And then you'd bring in the revenue number to add context.
Exactly. You immediately explain why the 16.7% revenue growth trailed the volume growth. It was because of the strategic intro of the lower-priced Envo sub-brand.
So you frame it not as a weakness, but as a deliberate successful market share grab.
Precisely. It basically says, we grew volume by over 40%, even while we were deliberately bringing in a cheaper product. That dual framing just maximizes the impact. It shows strategic depth.
And that is a powerful reframing, shifting the focus from dollars earned to units shipped. Yeah, that really reinforces the bull case right from the start.
Okay, let's move on. Let's talk about the fundamental shift in the business model.
The cash flow.
Right. The report calls the positive free cash flow the most critical metric for the bull case. And that's strong language. It's assertive, and it's correct. It's a historic milestone.
It's a massive change. For a company that's been burning billions since its IPO, seeing that shift, it's not just a balance sheet entry. It's a fundamental shift in strategic control.
And that brings us to our second point. The report correctly identifies the positive free cash flow as the most critical metric for long-term validation, but its placement as Section 3 just minimizes its fundamental historic significance.
So the argument is that even though it's labeled the most critical metric, the thing that kills the bankruptcy risk bear case, it's structurally buried underneath revenue and gross margin.
Yes. Think of it like the foundation of a house. Positive FCF means the company is self-funding its operations for the first time ever. This is the single biggest change to its risk profile.
Uh-huh.
Placing it after operational metrics suggests it's derivative, but it's not. It's foundational. Solvency comes before profitability. You have to prove the house is built on bedrock before you start talking about how nice the furniture is.
So the suggestion is you establish that financial safety net right after you hit them with the dramatic growth figures.
Absolutely. We suggest elevating the discussion of cash flow and balance sheet strength. Treat it as the core validation, the thing that establishes a strong fundamental floor for the stock before you get into the operational metrics.
Foundation first, then execution.
Exactly.
So structurally, how would we do that? How do we make that flow naturally after the volume discussion?
Okay, so a couple of concrete examples. First, you introduce the positive free cash flow and those surging cash reserves, $5.1 billion. That's an increase of about $1.4 billion.
Right.
You put that right after the volume figures. Maybe you consolidate it into a section you call financial stability, the self-funding shift.
And that $1.4 billion increase in cash, that's fascinating. Does the report make it clear where that surge came from? I mean, is it just operational efficiency, or was there debt or equity involved? Because the source of that capital really matters.
And that's exactly where the analysis needs more depth. Because FCF is positive, a huge chunk of that cash is operational. That's an incredibly powerful point that needs to be highlighted. It transforms the cash position from just a number into a testament to discipline and efficiency.
And the second part of that? The actionable implication? What does this financial bedrock actually let them do?
You have to focus on what it enables. Emphasize that NIO can now fund its own expansion, including the launch of the upcoming Firefly sub-brand, without needing immediate dilution. You link the cash position directly to future strategy.
So you're not just stating a fact from the past quarter. You're connecting it to the future.
Yes. It ties the FCF metric directly to their ability to launch Firefly on their own terms. It shifts the discussion from historic fact to future capacity, and that dramatically strengthens the bull case.
Tying FCF to brand autonomy, that's a crucial point. It really does turn the cash position into a central pillar of the investment thesis. Okay, that's very clear.
Let's transition to profitability now. The other key part of this report's narrative, the margins exploding story.
Right.
And it is validated. Gross margin hit 13.9%, a 320 basis point improvement year over year. Clear drivers there, like lower material costs.
It's a huge jump. But given the strategic shift we just talked about, capturing market share with the lower-priced Onvo, we have to apply some constructive skepticism here. While the margin expansion of 13.9% is strongly supported by cost optimization, the analysis could be strengthened by, constructively probing the potential risks associated with that aggressive Q4 margin guidance.
And the weakness there is the reliance on management's forward-looking statements. The report highlights that management expects margins to hit 15% in Q4 as the high-margin Onvo L60 scales up.
A forecast.
It's a forecast that lacks a critical counterbalance. The overall 40.8% volume growth is tied to the lower-price sub-brand, and that, intrinsically, is going to put some pressure on the overall corporate average margin, at least in the short term.
So the analysis needs to address that complexity. How do you dramatically increase volume with a cheaper product line and expect an additional 110 basis point margin increase in the very next quarter? That sounds operationally tricky.
Which might be great, and the corporate level average mix margin, which adding huge volumes of cheaper cars usually depresses, at least initially. So the suggestion is to introduce a brief, robust analysis that constructively challenges that path to 15%.
And that stops the margin section from just being a repeat of the earnings call?
Exactly. It provides a more comprehensive and balanced view.
Building on that, how do we introduce that kind of depth without sounding like we're just poking holes in the story?
You ask tough questions, but you frame them constructively. For example, you explicitly ask the reader to consider the logistics. Given the required Q4 acceleration, we're talking 120,000 to 125,000 vehicles, that's 60 to 72% year-over-year growth. What specific high-risk operational or supply chain assumptions need to hold true for that 15% margin target to be met?
So you're moving beyond the numbers into the real-world execution. The supply chain elasticity, the logistics, that's where the risk is.
That's always where the risk is in a rapid expansion. And you can also ask, are there short-term integration costs or ramp-up inefficiencies from the huge Onvo volume that might temporarily get in the way of that jump to 15%?
Right.
By acknowledging those risks, the ultimate bullish forecast on margins feels earned. It feels much more credible. The sophistication of the whole analysis just goes up.
That transforms the margin section from just positive data into a nuanced discussion of strategic execution risk, which is exactly what a sophisticated reader wants. It makes the whole piece more useful.
That depth is the key.
This has been a really insightful look at how to maximize the narrative impact of what is fundamentally a very strong set of earnings.
To sum it up, we focused on three main structural opportunities. First, restructuring the growth narrative to highlight that dramatic 40.8% delivery increase as the primary indicator of scale, and then using the 16.7% revenue growth for strategic context.
Second, we talked about elevating the historic positive free cash flow, putting it right up front to establish that foundation of financial stability and strategic control before diving into the operational profitability.
And third, constructively probing the operational dependencies required to meet that aggressive 15% Q4 margin target, especially with the new sub-brand strategy.